If you're a business owner or a high income pro, you know the pain. You make 400 to 500 grand a year, but because you're smart with your taxes, your returns show that you only make around 200 grand. And when you go to the bank to buy a rental or something, they basically treat you like a criminal. They want 2 years of tax returns, they want P&Ls, they want blood samples. So it's essentially a financial full body cavity check. And this is all to lend you money for an asset that pays for itself. You're basically being punished for playing by the rules. But here's the thing. Stop asking for permission based on your income. The bank shouldn't care about that. All they should care about is the asset. That is why the smart money is moving aggressively into DSCR loans in 2026. Where you don't use personal income, we let the house qualify itself for the loan. So what is this exactly? It stands for debt service coverage ratio. And it's just fifth grade math. Think of it this way. The bank isn't interviewing you. They're interviewing the house. They ask one question. Does this house make enough money to pay its own bills? If the rent's $1,500 and the mortgage is $1,000, the ratio is 1.5. Most lenders want to see a ratio of 1.2. Now, if you have a 720 plus credit score, some will go as low as a 1.0 ratio. But generally, if the rent covers the debt, the loan closes. That's it. The house is the employee. The rent is the paycheck. Your job, your W-2, your side hustle, none of that matters. This is how commercial real estate has always worked. We just took the logic from the 100-unit apartment building and brought it down to the single-family house. Now, here's why it's booming in 2026. It's for two reasons. First is what we're going to call the Fannie Mae wall. Most people don't know this, but Fannie Mae caps you at 10 finance properties. Once you hit 10, they cut you off. Even if you have an 800 credit score and millions in the bank. The DSCR loans don't have that cap. The limit is the deal quality, not a magic number. Second is the separation. This decouples your portfolio from your personal credit. Here's what that means in real life. Let's say you have to buy a vacation home or a new truck next year. If you use conventional loans for your rental, every property you buy weighs down your personal debt to income ratio. DSCR loans don't hit your personal DTI the same way. So you could scale the business without locking yourself out on your personal credit in your personal life. And then there's the speed. Look, a conventional loan takes 30 to 45 days, sometimes 60 if the underwriter gets picky. It is absolute brain damage. DSCR loans can close in 21 to 30 days because there's less paperwork to grade. The underwriter isn't reading all of your tax returns. They're just reading the appraisal and the rent roll. Now, if you're thinking, Jimmy, what's the catch? Well, here's the catch. Full transparency here. The rate is going to be higher. Typically, it's about a half point to maybe 1.5 points higher than a conventional mortgage. It's going to depend on your credit score. And frankly, half a point, 1.5 points, I don't really care. For my own personal deals, I use this financing and I don't really care. You're trading a fraction of a point for speed, privacy, and scalability. That is the trade. And I'm going to take that trade any single day. So the financing is the easy part. The math is simple and the bank is ready to wire the money. But this creates a new and bigger problem. The hard part isn't the loan. The hard part is finding the house that actually covers the 1.2 ratio. If you're just scrolling Zillow, the math is not going to work. To make this loan product work, you need a machine that finds off-market deals, that manages the rehabs to force the rent up, and hands it to the lender on a silver platter. And that is exactly why I pulled out this next video that's right here. It breaks down the automation strategy we use to find these assets. It also breaks down how we handle the contractors so you don't get brain damage and how we package the deal so the bank says yes. You'll see exactly how we execute that whole timeline in 60 days in this breakdown. So I'll see you there.